Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, September 17th, 2023. It's a little bit after 12:30 p.m. Here on the East Coast. I'm Wayne. My partner Ryan's working on some stuff somewhere, and we're going to get started with this week's program. Let's see where we are here. There we are. Disclaimer. Please take a quick look at that for us. And then please take a look at the intellectual property rights notice. And there we are with that. And then what I'm going to do is bring up this week's stream. These are the things I plan to talk about. I'll leave that up there for a little while if anyone wants to take a screen capture really quickly. I have to worry about doing it later or pause and take one. But that is a lot of stuff. And so we got to get started. I will flash last week's stream really quickly. And that way everyone can see we're kind of where we were last week. It's a little different, but not too much different. That happens sometimes, right? When we stay in these sort of corrective or pensive pause, whatever you care to use, when we stay in this type of a situation, and I think we're at this point bottled up for the most part without any news until we hear and see the FOMC information, and then we see the reaction and what they decide to do with it. And really that's ultimately what it is, because I've seen so many just the spin, however they want to spin it and take the market is whatever, that's what they can do. And it could fly completely in the face of everything. I've seen that happen many times. And so I don't really scratch my head anymore too much about it. I used to scratch my head a lot more about some of these reactions, but been a long time. Anyway, yeah, they can pretty much do what they want. So I wouldn't bank too heavily on you think you've got it nailed and this will definitely be the outcome. Could be, but again, they are capable of doing anything they want. And the media will take whatever they put out and run with it. And that's been my experience really over all the years. So on that note, I'm going to just briefly stop sharing, switch things around, and then we'll get into the whole program. Let me move this over here for now. And maybe I could get the share going on my main chart, and we'll maybe switch. No, actually, I think what I'll do is I'll switch the share to some of the screen 4 might be the best way to go. So let me see if I can do that. I'll start screen 4, and then we will move on from there. So let me just get this in front of me, macro measure stream. So yeah, so what I'm going to do is just do a little bit of review, and then we'll get right into it with a brief tabs check and go through everything as we often do. And I wanted to just let you know that I've got a bunch of tabs I'm going to cover. Some of them are going to be very brief though. So having said that, let me see if I can do this kind of a share switch. If it will let me do this, switch over to a slightly different screen here. And this one should be right here. And then I'll minimize that. So here's where we should be. I think you should be seeing oh, it's not doing that. It seems like it's not flashing that though, is it? Share 3. Oh, now it is. Okay. For some reason it got hung up. So this should be a chart of SMH. It looks like it is on Zoom. And I talked about this a little bit during cocktail hour, because I thought that, I think this is an important sector. We'll talk a little bit more about it in sector situation, which I'll record really right after this. But to me, this is an important sector all the time, really. And beyond that, it may be really important. I think the juncture it's at is pretty big. You can see that this support line we've been working with was broken on Friday. They did find support at the 100 SMA, pretty much where we would expect them to try to find support. And so we have to see what happens from here, right? Much like this low here, which was lower than a few other lows that had been made prior. They took that down and then reversed it. So you just don't know. Could this be just a slightly lower low they take down and reverse? Of course, right? So we know this can happen. So that's why, again, it's probably never all that easy to really be super confident. And when they throw in a Fed meeting, Fed commentary, Fed announcement, as we are expected to have this week, then you get the reaction, and you could really do a lot of different things. But this does look vulnerable. We made that point. There's a gap here that's down near the 200 SMA there in purple. That would be really another 10%, roughly speaking, from where we are now. So that could be pretty bad. And I think one reason why, and I'll sort of jump ahead a little bit here, but remember, I'll get back over to, let me switch us to a different screen. Let's switch over to 4 briefly and we'll come back. And so why I'm bringing this up is because we talked about this last week, and I left a lot of these tabs up here just as reminders, and we can just kind of whip through them now. But September's the worst month. September's the worst month, right? September stocks do not like September. It's the worst month. The rest of the fall, pretty good. September, not very good, right? We made this point last week, and so we're doing it again very quickly, as you can see here. And we also noted, right, that when you have the kind of performance we did, though, this year, you have a rough August, which there was less than a negative August, right, which we did, I believe. Down here, you can see the minus 1.8 in the S&P 500. Then what you typically get, right, for the final 4 months is you get this mean performance of 9.9 from the S&P for the balance of the year, and every year has been positive. So this is running up against a lot of other important things. So it's very interesting from that perspective, that will they be able to pull this off? Remember, if September's brings about further ugliness, then this will be even harder to achieve, right? That just shows you what kind of rally could ultimately be lurking. But we don't want to get too far ahead of ourselves. What I wanted to show was, I think it's one of these here. So let me see if I can grab the right one. Yeah, this is the one I wanted to cover. So this is really the AI phenomena this week. This is the phenomena that is really masked, right? If you remove the AI boom stocks, as they're doing here, you're really barely up on the year. You're up small. And so that is the whole story, right? Like if AI stocks, which a lot of these things are chip stocks, as well, right? If those things start to fail, that could really put a dent in this, and that's pretty much the whole game. And that's really what I was getting to. So if this starts to, the big story of the year really starts to come under pressure and doesn't hold, maybe due to specific reasons within, right, the news cycle, or just the idea that these things became overvalued and they're no longer good buys, and people will then realize they should be taking profits on them. So there's different ways to look at it, but I think this thing is just worth noting because of what's going on there in SMH and what's going on in the second half of September, right? So I don't want to do this quite yet. We've been talking about the second half of September for some time, and this cycle really for most of the year. And so I'm just giving everyone a quick review on this, that even in this third year, which is the best of the 4 years of the presidential election cycle, with next year being the second best year, you can see that the green line really does take a beating in the second half of September, right? Even in this. So that would be really in accordance with what the other tabs we've taken a quick review of. Now, beyond that, I don't want to jump to the slowdown. What I wanted to show was this, was that, look, the second half of September, when the first half is down, you can see what happens, right? The first half has been on the rougher side, and you can see that we end up with what we end up with here, right, is that first half of September down 1.27%. And you can see that we end up, typically the last several years where this has happened, several occurrences, you end up going down even further, right? So this is leading to that. Some of the worst parts of the month itself are coming up right now since 1950 as well. So this all points to some rough stuff. And so that's why I'm going through this a little bit, because it's almost some people might get a little worried, myself included, because it almost seems too easy that this thing starts to get its bell rung a little bit more. And I did note that of an important sector to me is SMH. It's gotten rocked. XTN, the transports, which will cover this, but all I'm really going to say is the transportation sector via XTN ETF. This is right. This is not a really good look at the moment. Sure, bounce is always possible, but not looking good. Gap down here that could still fill. I don't really get concerned about those until we start heading back in a big way towards that. But that is not really looking ideal at the moment. I wouldn't say that the bulls are fully in control of the transports right now. They just don't seem to be. And we'll talk more about other sectors later. But another couple of things that are macro are the dollar, right? And this made a new high. Right. So the dollar, the DXY made a new high and closed just off of the highs last week. And again, inverse correlation at the moment is the way I would read this. So higher dollar, not so great for equities. And then another thing that did that is also, or should say almost did that, got pretty close, is the 10-year yield. The 10-year yield. Oh, you know what? I forgot let me just go back and flip this for us. I thought I moved my chart over and I didn't. Let me move this chart over to here and make it easier. That ought to do it, but I'll go in reverse order. But the TNX is kind of creeping up there. You can see that there. So sorry about that little oversight. Now TNX creeping up is obviously right. That's yields moving higher. That's concerning. As I said, the dollar made a new recent high and it held very close to it. Again, these are inverse really in my book in terms of what's going on in the market. So I think this is a little problematic, to say the least. And then if we add in something like, as I was saying, right, you've got transports and semis that are, the transports certainly are not acting well. Come on, transports. Like I said, I don't know if you could really say that the bulls are in control of this market, because for the last 2 months, right, it's basically been sold off. So that to me is not a great look when you've got declining short-term SMAs like the 20 in light blue, and they're tamping down the action, and you're on your way to the 200-day as a result, which is the purple line there. So not a great look. Not saying you can't bounce from here, just saying right at the moment, the snapshot in time we're at here, not looking good. SMH, this could really get walloped as well. And again, that relates to that AI, which could really put the market's stellar performance, if you want to call it that, under great pressure, because those were the main reason why the market was able to do what it has done. And so there's the break below support. I'll highlight the support line. You're on the 100 again, as we noted earlier. Gap fill potential right near the 200-day. It's all there, right? It's all there. So it almost seems a little too easy, but look, I think the other problem is that if this month does end poorly, then I guess it depends on how poorly it ends. But if it ends super poorly, where there's an absolute rout, then that makes the bounce of the last 3 months probably a stronger bounce potentially, because like the trampoline effect is just the best way to say it, get a trampoline effect. So where you just really start to scream back, and that works seasonality wise as well, especially with the way the gang likes to mark things out at year end. But if you kind of just get an ugly second half of the month, that might be worse than getting a really ugly one, because that means we could drag on, in my book, the way that I look at it technically. So we will see, right? It's almost like if you're going to have a bad one, get it all out of the way. And if you're going to have that slow bleed that just keeps going lower, that's not good. That typically means from what I've seen, you're lasting longer, unless, right. And the only time that really it flips around for me is when, where I think it's better to have the slow bleed is when you've already had a really bad sell-off, and it's kind of slowly trickling lower, but not making super new lows, kind of just barely making new lows. And then a lot of times they'll arrest that and reverse it. So I don't want to act as though that was absolute the way that I look at that. But overall, this is just concerning. It's just the bottom line that is being the leadership sector, the transports being, to me, again, what they are. And I did note that we'll talk about in the sector situation, XLRE and XHB have been really finally kind of becoming a little more vulnerable. Worth showing XHB because I'll go right back to the tabs and you can see that this home builder index is coming off. And so now it is worth going back to these tabs to kind of finish those out. Here's the housing purchases by investors, I think. In real estate investors. So that's plummeting. Here's the home purchases fell at the highest rate in nearly a year, right? So things are slowing down, it looks like there. Holiday hiring is back to 2008 levels. If you remember 2008, it wasn't a picnic. It just wasn't a great year. It wasn't a great time, and it led to even, I think, an even worse time that followed it. So not good there. We already talked about this. Here's the situation where there's a bank liquidity indicator sounding the alarm right now. You can go check that out. Markets mayhem. We already talked about this. Let's see. I don't want to skip over too much here. And here's another example of bank loans dwindling last week. So we did cover this one as well. So you can see, right, there's a lot of different things adding up out there. And if we look at what we typically do with the percent of stocks over the 20-day, 50-day, 200-day, this is kind of middling, right? There's nothing really, you could make an argument that could go either way. You could make an argument that this can go either way. To a degree, it's down towards the lower side. I still think this has further to fall. I still think this has further to fall, the 2% of stocks above the 200. This, to me, should also take a beating this month. But again, the wild card of the Fed, that is the hard part for us. And that's, again, why it's never that easy, because you always have to confront something. This is just a reminder of what we've been sharing for most of the year. And just remember, though, despite the kind of doom and gloom that we got started talking about this week, the year really, in theory, should end rather strongly. We could jump ahead to here now. Wanted just to remind everyone that we're getting right up there, right? You can see the 2-year yield, and you haven't been up here, US 2-year Treasury yield. You're getting up there, right? You haven't been up to this level in some time, and earlier this year you were. It looks like on that, maybe right there's the high, or am I a day off? I think I'm close to it. So it's getting up there, not exactly at the highest side, but look, it's just been pinned up there. So again, I don't think that's good. Here's your probabilities, a quick check on your probabilities. So they're expecting nothing, the markets, that is, in terms of what the Fed does. And so this would be a real shocker if the Fed did do something. And in fact, the probabilities have really shifted around, where a week ago, they were thinking there was a 43% chance that we head up from where we are. And now that's only down to 27% chance, roughly 27.5 combined. So that is a big difference. You're neutral. So again, you can go either way. Here's your timeline. Again, you can go make an argument that we could find support near here and go, or you could make the argument that you think there should be more downside and this thing needs to get overdone. And I think that would probably be the way I look at it at the moment, because of what I'm seeing fundamentally. But I still need to see a little more technical rollover to feel like that's going to happen. And we may get it this week. We'll see. The other thing is that our survey, we did note that last week was not a great week for the market. It wasn't down immensely, but it was down, I believe, on the week, the Qs and the spiders, that is. And we did say that this might have bounced back a little too much. And now it's kind of come back to here. And note that the bullishness is below the historical average. The neutrality rating, or percentage, I should say, that is above. And of course, bearishness is a little bit less right now. So it's interesting, right? There's a lot of neutrality is the case I would make at the moment, that's just up there, where people are much like we've been the past few weeks, where they're like, I'm not so sure what happens here. So I think that's a good review on that. And what I should do now is just bring this chart over here for us, and then I'll switch my share so I can look at this better. Share, I want number 3. And then I'm going to take a look at our PowerPoint here, and I'll move this over so I can take a look at it. So let's make sure we're covering everything. I'll drop the spiders up there for us. And here we are in the spiders. And I think things took a turn for the worse. But let's go through methodically from the top line of the summary. And the review is, right, we said expect more of the same, which means back and forth. Where do they support? Where do they hold? I was saying that we were betwixt and between, right? And I did say you've got to keep your eye on the TNX and DXY. And they both kind of moved up towards the end of the week. And if you notice, that's really when the market reversed and traded lower. Now, the thing we have to note, though, is was this OpEx related? How much of that was OpEx related? And I would say it probably was somewhat OpEx related. Does it have that staying power that it affects Monday? Right? That's the question of the moment. And like I said, I feel like in the old days, I would have said, yes, that carries over to Monday with pretty solid confidence. But these days, I'm more inclined to say I'm not sure, because I feel like the market has lost its ability to remember what happened on Friday a lot of the times. I don't know exactly what goes on, but it seems like they are more than happy to ignore that Friday was an ugly close and just start buying again, or at least trying to move stocks back up again. So I think, right, again, you've got to keep your eye on TNX. You've got to keep your eye on the 2-year, you can, whatever, the 5-year, you can look at the 10-year yields. If these yields just keep moving up, I just think that is the real key to what happens in this market. But of course, you've got the Fed on Tuesday and Wednesday. But again, they'll be doing the, I think, 2 p.m. Eastern time. You'll get the announcement, and you get the Powell, I guess, commentary, et cetera, after that. And then you get what the market decides to do. There's usually one good head fake, if not more, that comes out of there. And we just are, again, still betwixt and between. If you want to look at it like you're between this high and this low, you can. If you want to note that I'm still between this high and this low down here, you can. You might even say this high and that low. You might even say this high and this low, because you're just between a lot of different swing points. And you need to see something, right, to really probably get better movement. We need to see either a breakdown attempt that's real, that becomes real, or a breakout attempt that becomes real. And I'm leaning more towards the fact that this is a lower high, this is a lower high. So you've got a couple potential lower highs there. And I do think that if it were not for the Fed, I would be more inclined to be really get my bear lean in place more. I think you have to start thinking more about, let's say, being defensive, staying at DEFCON 2, which I mentioned in this week's notes, because I do think the market finished in a way that's concerning. And I do think some key sectors are not really looking all that appealing as a bull. They look more in terms of the momentum. I'm not saying that they're long-term not good places to buy. I'm just saying the momentum certainly wasn't impressive in these things of late, and especially with the finish of last week. And these are key sectors. I mean, I don't think people talk enough about the sectors in with respect to the XLRE and the XTN, or you can use other ETFs if you want as proxies for what's going on in the real estate market. But I think those look concerning, and I think for good reason, right? Because I think housing has just become exorbitantly priced. It's stretched far too much. People cannot afford it, especially at these much, much higher interest rates overall. And I think the market is slowing or coming to a dramatic screeching halt almost compared to what it was doing. It'll never, of course, come to a halt. People have to buy and sell to move at times, but you get the point. It's just not, the activity to me is on its way to a great decline if rates stay here or higher for any length of time. So we've been going for 3 weeks now saying that we did not have a very strong lean. And we also said that we think you need to stay between the swing highs and swing lows. And this started back here. And, when you got through this high, you got a good push, right? But you couldn't break the lows prior to that. And you really couldn't even break out above. So we've been stuck in a way for that reason. I think if you're being nimble and you're still cranking out some respectable profits that you're happy with, I think you're doing an excellent job, because this is, to me, this is the hardest parts of trading, is for directionally when there's a lack of really sustained momentum. You've got to just be so nimble to really be, capture consistently. So I just want to remind everyone that, and this is not really a direct shot, but it sort of is, I guess. It's not a like, hey, I told you so. But a lot of people, I won't mention anyone in particular. People want to see more conviction when they watch a video. And I guess that's sort of been the maybe tradition that's been established. Why are you even saying anything? Well, we just cover the market week in, week out. So why we're saying something is because of that, right? But I probably wouldn't say much if I thought we were still stuck and we didn't put videos out weekly. I would only want to put something out when I thought there was a real change. And that might not fall on a weekend, right? It probably would fall during the trading week when I think something that's materially important has happened and the technical complexion has shifted as a result. And that's kind of few and far between. So we're just trying to frame how we would handle this week's trading from a mindset perspective with these weekly videos to try to help out, just from having done this for such a long time. So I do think, right, that the onus is on bulls. They are the ones that are under pressure. But I just want to point out that the lack of a strong lean in the last few weeks has been the right answer. And it's not really a ha or I told you so. It's just that I've seen it so many times. And that is the reason why a lot of these, when we're not really strongly trending or we're not ready to come off support and bust higher or come up to resistance and break higher, or come drop below support, that I'm really not highly convicted. And that's just because the market doesn't tend, in my opinion, over the course of my career, the market hasn't tended to perform strongly when it's sort of betwixt and between two key swing points. So that's the rationale. Whether that's appreciated or not, I have no control over that. But I still think that was the right answer, because the market did try to rally and then the market failed. And so that to me is you really closed just a little bit below where you were the prior Friday. I don't even think you closed 1 full percent. So we closed at 445. We were down about 2 points. It's about 0.5% change net on the week so that to me is a pretty good, when you guess that stay nimble, range bound, kind of not a strong lean, take what you can get, and you only get half a percent. I think you're on, you were on it for the most part. And that's, as I said, that's what I found. If you really can't find a really strong lean, there's a lot of counterbalance, sort of messy TA signals that cancel each other out, nullify each other to a great extent, then just trade whatever comes your way. And instead of being ready to get a little more aggressive one way or the other, just take whatever you can get until you get to a key swing point, and then see how overbought, oversold you are. And then if there's still legs and there's ATR left for the week and so on and so forth, then you just reevaluate when you get there and say, is this thing going to break out? And it depends on the developments maybe within the market too. How much buying and selling is going on, right? The seasonality, there are a lot of different factors. But anyway, that's kind of the quick review on last week and all the tabs. This week, I think that you could still easily pivot in either direction. So I think if they hold here above that low from the prior week, that would be about 442.75. Don't be surprised if they kind of gap it down beneath there on Monday and then reverse it, because they do very well when they do that. But if you look at this, to me, this is not good. And this is just all these different things that I like to look at. And they're not always applicable, but I think right now, if I drew another line in here, and I like to look at things sort of as the stocks are operating within channels. And if you say that this was an established channel, and I think everyone knows what I'm referring to, and you try to rally off of this channel a couple of times and then you failed, channel support that is just not a good look with a lower high put in, right? So to me, that looks overall, like if I just look at the pattern right now, it's very hard, I think, to be impressed by it. I think it's a lot easier to be concerned by it. So that's kind of where the bearish lean is coming from, along with what I saw in the sectors, and then the other macro drivers, which we've talked about, almost to death over the course of the year, which is TNX and DXY. So that's that. Now, I did note that both of those moved up again. They're just below recent highs. This is what I think could eventually break this market, is that if they start to really power. And I think that's possible, but also we have to note that the probabilities, as we saw, backed off, right? So the expectations that we go up from here have been really reduced dramatically, right? The probabilities have been reduced dramatically. Therefore, you can't rule out that this thing's almost maybe ran its course. I don't think it has, but maybe it has, right? At the moment, I'm not as confident that we're definitely going to bust through and go much, much higher. I need to see more information, right? More news develop. But I do think that they could signal that we're pausing for now, and you could at least have a temporary, back off in rates and things. So just keep that in mind, because the potential, I think, is there. I still think that the long-term trends are in favor of bulls, because all you really have to do is a simple way to do that some people really like, besides the price structure, is just to look at your SMAs. And the gold is, I'm pointing to the gold 50. Here's the 100 in dash white. This is the 150. They're all the longer terms are upsloping, right? From 50 on down. And then even the 20-day in light blue, that is neutral to positive. So the shorties, yeah, they're starting to get a little concerning, but overall, if you had to just say, I'm taking a picture of where things are right now, you'd have to say the long-term trend is still up. You haven't really broken anything. You haven't broken support in a big way yet. You might be on your way to doing it, but I just mean at this very moment in time. So we can't forget that, right? This is why I think, again, another reason why this game is not that easy all the time. There is a wall of worry. We pretty much produce a wall of worry every week here in this video, and then Ryan and the gang do in terms of the market outlook, because what we're trying to do is keep everyone apprised of risks, because we feel as though most of the historically, there's been just too much cheerleading, and we want people to respect the risk side. So we always try to cover that. But I do think we have legitimate reasons to be concerned or worried. And remember that the bulls are really good at taking that and turning it on its head and moving the markets higher, right? So that only helps if the bulls are not forced to confront realities that we all think maybe, or many of us think are out there. What that means is that they'll be able to turn the tables. And you get what we've seen since October, this massive rally where many people thought we were on the verge of a complete collapse because of how things were going. But just so keep that in mind. Do also keep in mind, right, that with respect to these rates and yields, that the real carnage begins once things back off. So if the Fed starts to say we're closer to like holding out and then cutting, that's when you, believe it or not, according to what Ryan uncovered, that's when you end up getting some of the worst performance in stocks, because it's the Fed scrambling because they realize that they've over tightened, and there's going to be this really bumpy period. Do note, however, right, that the buyback blackout period is nearing. From what we can tell, the next 4 to 6 weeks, with earnings starting to come out, you'll see where a lot of these buybacks that have supported stocks, especially some of those large caps, that's dying off. I still don't see what everyone's excited about in terms of short-term catalysts and how wonderful they think things are, clearly. But their stocks are on sale the third year, which we talked about, and a little bit of a shift towards bad news is good news, because they like the fact that we're going to maybe start to level off and then start to see rates come down. Remember, that's what they like, but then when it really becomes obvious that that's what's happening, that's really when things get rocky. There are upside EPS revisions, so I don't know if that's complete hallucination on the part of Wall Street analysts in the consensus, or it's real. I mean, I guess it's possible that they were able to again, shrinkflation their way to even better profits. But I know there's a lot of pain out there online. I saw several videos of a bunch of folks talking about how, on the one hand, nominally they're making more money than they ever have, and on the other hand, their life financially has never been harder than this because of really where prices have scrambled to. Market breadth, which took a hit the prior week, was coming back a little bit this week. That actually did take a hit. So I'm not going to really go into that, but I'm just noting that that took a little bit of a hit overall, but nothing extraordinary. So again, I think the street is under the impression that somehow corporate America will put the screws to U.S. consumers successfully again, and that'll give them another really good quarter in terms of beats, which are engineered. We know that. Again, the sectors are messy. Just a reminder on that. Second half of September is poor if given what the first half has done. So just be ready for that. What else can we talk about? Like I said, SMH has the bulls on auto redial. So in other words, the bulls really have to answer the call soon, because if you're a bull and so much has really of this rally has been concentrated in these AI related stocks, and then you see the semiconductors, this thing is leaving a channel it's been in potentially, and here's the support of that channel for a long time. And so that really, to me, is what you got. One of the other things you really have to keep your eye on, that leadership area is starting to get cracked, because people take cues from that stuff overall, the way that I see it anyway. So this is this, if we do get more selling and we start to see things really turn rough here in the second half, like it seems like they could, I'd say, look, that could bring that question of, was the October through July jam job, was that the AI kind of paper over things mirage, and really things were not getting any better? We weren't leading into a new bull market. Or, right, are we going to just have this little weak period and then we're going to see stock support get back on their horse and do what they typically do to end this third year? That's the big question I think that could develop. We will see. I don't listen to enough financial media anymore. I just had to get away from CNBC. It became, after many years of kind of like keeping it on, grinning and bearing it, listening to it, I just couldn't do it anymore. I switched to Bloomberg like a year or something ago. I just couldn't handle CNBC's routine. Just deteriorated in my mind just too much. So I'm going to go with the bottom line is, look, we can talk this, that, and the other thing, and I will chart a few things here, but the reality is that can they do anything here to change from the Fed, right? What the Fed's going to do. And I don't think they can. I mean, in other words, like, I don't think I could be wrong, but I don't expect the market to get walloped. I think you're going to get whatever the Fed's going to do. I think it's pretty much baked in, unless there's some extraordinary news story. So whatever's coming, probably has a very low chance of being changed, and that can be spun either way. So we can get all huffy and puffy and confident or table pounding or whatever, but it all could shift on Wednesday. That's the reality. I would stay at DEFCON 2, which means you're really close to going to DEFCON 1. And it just depends on how, I guess, Wednesday's afternoon plays out. That's really the thing. I don't have anything strong to say because of that. I think if we did not have the Fed meeting, this is what I would say. If we did not have the Fed meeting, I would definitely be more bearish lean. I would be expecting and then say, like, look, we know there can be false breakdowns. We know that they can take things below key levels and play all kinds of games with them. But what I would say is, look, if this thing starts breaking down and you see the dollar's roaring, yields are roaring, the VIX is heading up, which it managed to do on Friday somehow, or that's a relative rarity. It was on its way to it. It had a 12 handle at one point, and they reversed it and brought it back up by a point or so from there. But here's the SPY, and to me, this could be this really should get rocked down to me towards this 100 day. is the way I would look at it. I think there's just too much deterioration happening, and with yields just absolutely not cooperating yet. On the flip side, right, if they did take yields down in a big way and the dollar backed off, I could see them really starting to screen this thing. So I think, again, that's going to be your cue. I'd still be more of a bear if we started breaking down and there was no Fed meeting, even if rates and DXY were neutral. If rates were neutral to or only up small, something like that, I would still be more of a bear with this lower high put in, this break of support, and then some of the other sector developments that I saw and the breadth developments that I saw, and the fact that I think there should become more corrective activity that's unfolding. But the other problem I have to note is that, do I really want to get confident based on one day's actions that was OpX influenced, and maybe to a large degree? And do I want to do that right in front of a Fed meeting where the expectations are that they sit still, and maybe the language changes to say we're sitting still longer, and maybe the language changes even beyond that to say we're sitting still, and we haven't ruled out that, depending on the data that comes in, that maybe we'll be cutting rates if inflation really does seem to have been snuffed out. I don't think it has been, but you just never know. You just never know. So that would be my take on things, is that I'd be more of a bear if it were not for this Fed wild card. The other thing would be, and that kind of goes against the long-term trend as we discussed, but I think I'm seeing enough concerning signs that I would be willing to take that trade and then see what happens. This, you can also see, right, that I've got the channel. I think we drew this in last week, which again, we drew it in the SPY this week, but you broke down below the support in that channel, and you've got these lower high put in. You broke the 20. That was the last of the short-term moving averages. You're now below the 20 and the 50. The 50 is there in gold, the 20 is here in light blue. And if you break down below there, right, and I think this line really was meant to be at that low for that particular swing. And I think that's what you're waiting on. If you start to close below there, then you start to open up or invite the possibility that you drop back towards this 100 there in dash white. And so that would be, right, a problem. And then you would see if it does get to there, my eye would then say, well, what happens at this swing here? Does it hold near that swing? Do they try to kind of put a widened sort of double bottom together, or a slightly higher low in place there? That we'd have to start looking at what's shaping up when we get there. That would look something like this, though, right? It would sort of be like a period where you corrected, you came back up, you were a little choppy here and there, right, without a lot of range bounds to a degree. You broke down again, but then you found support here and here near where you found support over here and here to a great extent. And then, right, that was during really the conclusion of the downtrending phase. This would still be happening in an uptrend. So in theory, right, you would be more than likely to have a bullish lean, especially if things are deeply oversold there, and you feel as though whatever the fallout is, maybe from the Fed, it's ran its course, and you're starting to see some signs of oversoldness really permeate the market. And then the gang starts coming in and moving things back up very aggressively with some buy programs. That would be one way to handle it. But that's what I would expect is the next area. So let's put that at like 359 in Qs, just to kind of ballpark it for us of where we would expect this to start to arrest if there's a drop off, and you need to get the start of the drop off first, right? And then spiders, I'll do that one. We'll do diamonds, we'll do IWM, and we'll kind of wrap up at this point. But just enlarge this a little bit, and you can see just not a good look, right? We talked about it already, and I think the 100-day again is a big deal for if you're the SMA players out there. There's going to be flat lines right near there. You're pretty much looking at, let's say, we'll call it 436. So that's another roughly 2%, right, that we're looking at in SPY. So that's nothing extraordinary. Diamonds they've actually held up fairly well compared to IWM. And there's a lower high there, right? You can see that there's a lower high there. We come down here, it looks like it was one of those reverse divergence situations where you have a stronger reading at one point in your RSI, but the high was a little bit lower, right, in this case. So not the standard, right, negative divergence right there. But that's still uptrending. You can see, I think it's obvious that it's uptrending, but it's at risk, and it possibly does have a little mini double top, if you want to give it that here. At least two lower highs relative to back in here. And right, again, I would expect the 100 and then this swing. It's all the same across them all. It's the 100 and the swing on all these things, right, that I'm looking at, and that it's not that far down. So it's not like it would be the end of the world to visit there. Probably the exception to that is IWM, which that clearly has a much lower high relative to this high. And this thing's already flirting with the 200-day in purple, which is the last of them. Last of the SMAs has the gap over here. So that could end up coming into play. And really, this makes sense to me. This is one thing that does make sense to me. It's also about to break, we think, a support line, right? At least the way that I chart. So I think it's on the verge of breaking that support line with the lower highs in. It looks a little scary. Someone could say there's a kind of like a flat shouldered head and shoulders in here, and that should bring lower prices about if you believe in those. Still, the long terms SMAs are basically flat with a few rising. So kind of more neutral, I would say, especially when you mix in the fact that the short terms are looking kind of rough and they're falling below naturally the longer terms at this point. So if this has a rough finish to the month, I think it's going to be in bigger trouble. Now, that also makes sense to me just because of rates. And I think these companies that are smaller tend to be more dependent on financing, right, for cash flow issues and for just expansion and managing their affairs. And maybe that's harder to come by or it's unattractive to them because of rates being where they are and how quickly they've moved up. So I don't think it takes any kind of a chart master to note that there's vulnerability here flashing across the board. And usually when it's this obvious, it worries me. So it kind of does a little bit that there's really some problems here. And I think with that wild card that we've got with the Fed, that really gums up the works. And there is usually a square up factor where they will come in and they'll usually without other news affecting things too much, right? That on kind of like later on Tuesday into Wednesday morning, there tends to be a square up at times. We have seen them get away from that though at times where they kind of just do what they're going to do with the market. And that would be movement one way or the other. And then they only square up really very late in that process, maybe just a little bit, maybe like an hour in front of the Fed announcement. But this would be the downside. To really get me excited about the upside, right, I'm ultimately want to see this high get taken out. But if you want to say, well, I'm prepared to trade in either direction here in the IWM, which I think is a really good trader, a good mover, I would keep an eye on the fact that this RSI situation here, these oscillators, these are registering on this low, registering a little bit better than this low. So things are a little bit better from that perspective. And so if they get through that Thursday high and they're liking it, I don't see why they couldn't try to make a run in a bullish scenario up to the 50 there in gold. So I don't expect that. But remember, these guys are the masters of squeezing, right? And when they draw new people in, new shorts in, it makes it easier for them if they can turn that around to get people chasing. This is really what causes so many of these rallies, or at least aids them. Here's the big dog Apple we should look at too. And this also looks right, the way that it finished the week, it only managed to really lift itself up from the 150, but not a good close, right? So again, that's getting pretty vulnerable. I'd say, look, the 150s there in rust color, so keep your eye on that one. But this low getting taken out here at 170, 196, that probably, if you're in a risk off or just the market's being sold off, that's probably what your level to say, like, look, this thing really starts to trade down to that 200 there in purple. This also, to me, is at risk of having a rough monthly finish. And if it does have a rough monthly finish, that's typically not good. That probably means we're not out of the woods for rough stuff, and you're not getting back to all-time highs, let's say, in the market anytime soon. You're probably in for a couple more rough months, to say the least, and you're this instant, like, hey, we're right back to where we were up here type of thing, probably is not a short-term reality. Excuse me. So I think there's some real, the way that those technicals are shaping up is concerning, and that's brilliant. And I think there's a meta story, and I think I had Meta and Tesla as ideas, and they looked ready to go, but the weakness in the market really put a hurting on them. They just couldn't break out and trigger and hold the trigger level. I don't think they got to it or didn't hold it. I can't remember. But the point is that Meta, I think, has a negative story out over this weekend as well that Ryan sent to me. So that could be problematic, such a big name there. And then the Tesla, which again, I think a lot of times the market's taking its cue. Tesla just couldn't do much in that heavy market. So I thought that chart looked really good compared to others. I did note, I think at the time, that it was a little bit approaching sort of like short-term overbought, not in an awful way, but might get a little gap closure. Who knows what happens? But the market just was too heavy. But overall, but again, some of these, just keep your eye on some of the big ones as usual, because if they can start to marshal them back up, then maybe they get a little bit of relief, or they paper over some other issues, which is pretty much par for the course. So I think on that note, we'll wrap things up, because it's been a pretty long one here, a little bit longer than I wanted, but there's obviously a lot going on at the moment, and it's a very interesting market where you're at a juncture too, where this could really be a decisive time, right? Where if they're going to trash September's close, the closing of the month, it probably happens starting soon. And if they're going to start positioning themselves to have those solid final quarter and maybe try to rally into the earnings releases that will be coming up in about a month, when it really gets hot and starts to get hot and heavy, that would maybe commence soon, right? So you've got a lot of different long-term cycles and so on and so forth against a big time macro situation that's kind of looking rough at the moment, including people getting squeezed again in a big way at the pump. So, and they're already feeling squeezed. So it's a tough one. It's a real tough one. So overall summation, no Fed. I'm a bear, and I think we're going a little bit lower, and we see where we get to, and we see what support they try to hold things at. Because of the Fed and OPEX, don't want to read too much into it. And again, I think you stay nimble, but I think you have a little bit more of a lean towards either playing defense on if in bullish trades. In the absence of news, you've got to probably be a little bit more ready to take the profits. And bears, I would probably say, if things are shaping up bearishly, I think that's more of the natural course of what would happen. And I'd probably let that, if I can do that and let it deteriorate in front of the Fed before the square up starts, I probably handle it that way. So on that note, I hope that I shared something with you that helps you out this week or a week in the future. And I want to thank everyone for tuning in. See you in the updates and webinars during the week.